from Mr. Kaczmarek's second report, we see that it starts from the DCF of 1,406,000,000, which we had in the last slide. See the result of these criticisms resulting in 1,406.7. The revised valuation conclusions of Mr. Kaczmarek start from this 1,405.7 for the DCF analysis in the but-for scenario, and 576.2 in the actual scenario. Then comparable public company, comparable transactions. We had discussed how these have been weighted and the average resulting in Mr. Kaczmarek's calculation. This goes to 60-30-10. Then it's 1479.3 millions for the but-for, and the 562.4 in the actual scenario that we've discussed often throughout the hearing. You will see the next line in his calculation is excess net debt, and this is actually what was the discussion about whether the cash flows to the entity or cash flows to the shareholders is residing. Yep. And so just to point that we go to table 14, we have the summary of revised damage conclusions by Mr. Kaczmarek in the first arbitration. That's 21 million for lost cash flows and 222 million for lost value. And lost cash flows is of course, hasn't been retermed in parlance before this committee as historical losses. Now we go to the resubmission proceedings, slide 62, slide 63, actually. And this is taken from Kaczmarek's fourth report, which is the last report in the resubmission arbitration. Table 13, you see we start the but-for under the DCF analysis is the same 1,406.7 that we had in the first arbitration. Then we have, again, 60-30-10, and that ends up with the enterprise value, the weighted average, 1479.3, same amount that we had in the first arbitration, and the same net debt that we had just discussed from the first arbitration still appears in the summary of claimants' loss of value damages in the second arbitration. So nothing really has changed there. We see then from going to slide 64 onwards, we have snippets from Dr. Abdallah's conclusions and criticisms to Mr. Kaczmarek. As we mentioned, there was no separate DCF calculation performed by Mr. Abdallah, but there were a series of corrections that were suggested to Mr. Kaczmarek's calculations. We simply have identified the most relevant portions of those criticisms in slide 65, 66, 67, 68, and so we have at slide 69 a comparative between the damages calculated by one expert and the other.
Stop there 1 minute because I need to make a note. Sorry.
Sure.
Please continue.
Absolutely. So you see here, these are tables 1 and 2 from the fourth Compass report from September 2018. And you see here the calculation of the actual arithmetical impact of taking all of the conclusions by Mr. Kaczmarek and all of the conclusions by Dr. Abdallah, and how that changes the values that each of the parties is arguing. And in the comments I was making before about contradictions on the interest rate, you will note, of course, that this speaks to these same charts that we're seeing here, where there's a discussion of the interest rate and what the rate is in the damages being sought in the red column to the left by Mr. Kaczmarek, in the right column by Mr. Abdallah on the right.
Yes, and when you say Kaczmarek and it says DCF plus multiples, the part about plus multiples, that only affects the actual value, correct? There's no multiples approach used to calculate the but-for. I mean, theoretically you could, but I think it's kind of difficult.
It would certainly be difficult. I think you're correct, Madam President, yes.
I can look at the other side. Were multiples used to establish the but-for? I think I've only seen cash flows projections. That was all.
Let me confirm, because I thought that he, whether he used all three methodologies for the but-for or not, which you could do, because absent the measures,
It's difficult because how do you do it? You establish a new set of transactions. You look for other transactions based on.
I believe there were. It was more than multiple. Let me refresh our recollection so I can give you the accurate answer.
If we go to slide 58, there we go. And this is what Mr. Kaczmarek said he did. And he does make, for the but-for valuation, he makes a weighted average of DCF, comparable traded company, comparable transactions.
Okay, in theory, it's possible. It's just a bit complicated because, I mean, the assumptions you use are not that different when you're in the but-for and the actual. But of course, you could find another portfolio of transactions that don't apply to the actual value, but would be relevant for the but-for.
Which is why, Mr. Abdallah, one of the criticisms we had in one of the slides for the opening presentation of Guatemala 2 days ago, which is why Mr. Abdallah said, for a project of this type, for purposes as you want to use this for, you cannot use comparables. You have to do DCF.
Yeah.
And that's the precise reason for that criticism, which, of course, the committee will have noted, was not mentioned.
Another minute, I need to make note.
Yes. Can take 2 if you need.
Thank you.
So thank you. So just to begin with a comment to follow up on your question regarding the lack of a DCF model from Dr. Abdallah, which, you know, I do think is an important point and was discussed at length in the resubmission hearing in particular. There was a discussion where Dr. Abdallah is being questioned about that, and he insisted that it would be impossible to do a DCF in the but-for scenario and to project future cash flows. And his insistence was it would be impossible because you cannot know what the future tariff periods would be. You cannot know what a tariff in the future would be. And we said, well, that's okay. You never know what your future cash flows are, no matter what kind of business. And in fact, in this particular business, it's a regulated utility. They have a lot more certainty than many, many other businesses around the world. Everyone can do it. It's whether your assumptions are reasonable, because at any one point, you should be able to value the business. You could sell at any one point. And there was this back and forth, and he kept insisting, no, it cannot be done. He did not want to take a stance on that. And so he just simply refused to accept that you could do a DCF. And there, at one point, he did say, yes, you know, when I said, if you were hired to engage somebody to purchase this company, how would you tell them, like, what type of bid to make for it? And then he did say, well, yes, in that circumstance, I would need to do that, but you can't do that here. So that was his stance. And instead, he adopted something that I've never heard of before or since, which is called the so-called perfect foresight model, which means you can project, you can value the company, you have perfect foresight, so you know what the future holds. And that is your projection, which means your but-for always equals your actual, and hence no damages. Because you had perfect foresight, you would know in the future what things, it makes no sense. But that was his primary contention. And you will see that throughout his reports, and you'll see it at the hearing. And he talks about the perfect foresight. And that's where he kept coming and saying there would be no damages because if you did forecast, you would know what it would be and it would match the actual. So as far as what Mr. Kaczmarek did in order to establish the but-for cash flows from 2010 to 2013, he had to, of course, look at what was the company's revenue and what was the company's cost, or to forecast the revenues and the cost. So when you look at the revenues of the company, the revenues are in the electricity tariff. The vast portion of that is a pass-through because the company pays for the electricity that's generated and then, passes it on to the consumers. The consumers, you have the generation, the transmission, the distributors. EXO is a distributor. So the last in line, they get the money from the clients, the customers, but a lot of that is then passed through to the electricity generators. The portion that they retain for their service is called the VAD. It's the value added for distribution. And that's the value that they're adding, is they're distributing the electricity to the final user. So that's when you're talking about their income, that's what you're looking at, is that VAD. So for 2010 to 2013, the VAD that he used for the income was on the basis of the Bates-White study. The Bates-White, as you know, was the consultant engaged by EXA that had been pre-qualified by the CNEE, which was the electricity regulator, under the framework that was tasked with preparing the VAD study. And so that's what the electricity distributor, in consultation with its pre-qualified consultant, prepares the VAD study. The CNEE, which is the regulator, looks at that VAD study, can provide comments. They're supposed to then go back and forth. And if they can't agree on those comments, it goes to an expert committee who then decides on those issues. And that was all part of the original arbitration. Ultimately, the original tribunal agreed that, but for the breach, had Guatemala not breached the treaty, the VAD should have been set at the rate in that revised Bates-White study, which was the final Bates-White study. Instead, Guatemala set the VAD at a rate pursuant to their own VAD study, which was called the SIGLA study. And so the differential between those two VADs became became our damages for that historical loss period. For the 2010 to 2013 period, because that VAD didn't change, and the original tribunal had decided, and that was not annulled, that they breached by not adopting the Bates-White VAD, that VAD remained in place for the 5 years. It doesn't change. So that was the income, that was the revenue for 2010 to 2013. So he did not have to forecast that revenue. Now, the revenue in the VAD study is in real terms. So he had to add an inflation adjustment to convert it to nominal terms. And he did that by using the producer price index. Dr. Abdallah initially did not object to using the PPI to adjust for inflation. Later, he suggested that Mr. Kaczmarek should have incorporated a local currency inflation element. But had Mr. Kaczmarek done that, it would have had the effect of increasing the VAD and thus increasing the but-for scenario cash flows and claimant's damages.
Was that one of the 4 criticisms? Is that one of them? No.
No, because it would have, or was it actually, I'm sorry.
Because I kind of have 3 clear in my head. Sometimes the 4th somehow escapes me. So can you just, at some point, refresh my memory of what the 4 criticisms were?
Sure. And if I may, while we're in this small interruption, we have refrains from arguing the merits of the damages calculations by one party or the other. And you have the transcript of what we just discussed today. We're just looking at the slides. This is what they said. This is what the other party said. This is what Mr. Kaczmarek said. This is what Mr. Abdallah said. We did not engage in any argument as to reasonableness of Mr. Kaczmarek's calculations or not. And we are hearing now a litany of criticisms to Mr. Abdallah's calculations, which I think are beyond the scope of seeing what one side and the other was saying. If it's irrelevant to the committee,
I haven't heard anything that I deem improper. So please do continue.
Thank you. Okay, so that was on the revenue side. And so then he had to forecast the costs in the but-for scenario from 2010 to 2013. So he started from EGS's actual costs and forecasted. Typically, one would look at the most recent actual costs, which would have been as of the valuation date, 2010. He did not do that. He instead took EGS's actual costs from the end of the year in 2007 and projected those forward. The reason he did that was because the new tariff or the new VAD that had been adopted in 2008 was cut by 50% from the previous VAD and had decreased EGSA's revenues by approximately 40%. In reaction to that, EGSA took severe cost-cutting measures. So when you looked from 2010 forward, the costs were significantly lower. If he had used that as the cost basis to project forward, EGSA's costs would have been lower, which again would mean that the but-for value would be higher, claimant's damages would be higher, when really what you're trying to do is you're saying, but for the breach, in the absence of the breach, we would not have taken those cost-cutting measures. So we did not take like an unfair advantage by using those most recent costs. We went back to pre-breach 2007, took those actual costs, projected them forward, projecting them forward with only using an inflation rate and the forecast for the growth in EGSA's customer base, which also was taken from the Bates-White VAD report. So then Mr. Kaczmarek then had the EBIT, the earnings before interest and taxation, which is just taking the revenues minus the costs. So then he had to deal with taxes. He assumed an effective tax rate, income tax rate of 38%, which was based on EGSA's historical effective tax rate over 5 years prior to the valuation date. We note, and this is all in the reports, that the corporate tax rate in Guatemala was 31%. So this was a conservative assumption because, again, it results in a reduction in EGSA's cash flows. Then he had to deal with CapEx, capital expenditures, and he used the CapEx projections that were in DECA 2's forecast, which is at C1145. The original tribunal had agreed with his CapEx forecast, which was also used for the earlier period, and it was not disputed by respondents' experts in the resubmitted arbitration or at any other time. You then add back in depreciation and amortization, as non-cash expenses. And then the projections are based on the CapEx projections and the anticipated useful life of the assets of the company. And then finally, there was an adjustment for working capital. And then that gave you the free cash flows to the firm. Then you took those free cash flows and you have to discount them back to the valuation date using the discount rate. The discount rate was EGSA's WACC. EGSA's WACC also, it's actually calculated by the regulatory agency, the CNEE. They put out a resolution because pursuant to the resolution, the WACC is also supposed to be the rate of return. And there's a ceiling and a floor. I believe it was needed to fall within 7 to 13%, and EGSA's WACC was 8.8% for that time. So it's discounted back at that time, and there was no dispute between the parties, experts, or the parties on the discount rate. And so that was how he calculated the but-for cash flows for that period.
were Mr. Abdallah's criticisms regarding the calculation of the free cash flows, were they new in the resubmission proceedings?
Yes. So in the original proceeding, there was no criticism that the cash flows had been calculated to the firm. And it was in the resubmission proceeding that he argued that they should have been calculated to the shareholder rather than to the firm. So that was a new criticism that was first raised in the resubmission proceeding.
And about the other three?
They were all new for the resubmission
They
proceeding.
were new.
Yes.
Of course, because Abdallah's standpoint before was it's impossible to project anything. And now there was at least certainty that a breach had occurred.
Not quite,
that-
Madam President, because when he was saying it was impossible to do anything, that was at the resubmission hearing.
Already.
So that was at the
sorry.
resubmission hearing. So he had calculated, again, he had made a calculation of of TECO's damages in the original arbitration, and he had raised a number of different issues. He did not raise any of these issues. So those issues and criticisms that he raised in the original arbitration were all fully ventilated by the parties. The tribunal then adopted Mr. Kazmarek's model, and then coming back, he's raising these new 4 additional criticisms that had not been made before.
You wanted to ask something?
Yes, and in response to your question before, where we would have these 4 and why there were 4, and I think this is exactly what we're talking about here. It's slide 767 of our presentation today. It's taken from pages 8 and 9 of the 4th Compass report in the resubmission. Yeah, 67, yes. So this is, you'll see there's 4 elements being discussed, and this is Roman number 1, cash flows and discount rate. And basically you have here the discussion. TECO was a shareholder of EXA, and so the cash flows should be.
Give me 1 minute.
Sure.
Possible? Yes.
So, thank you. The first one is the cash flows and discount rate. TECO was a shareholder to EXA, so any damages it could claim should be free cash flows to the shareholder. Committee will remember there was a net debt in the range of $87 million at EXA, and so of course that is a significant difference if you measure cash flows to the entity or cash flows to the shareholder. The second one is operating costs. We have Roman number 2 here, and basically here what Dr. Abdallah is saying is the valuation by Mr. Kazmarek uses its own assumptions instead of the ones that the original tribunal had used for calculation of historical losses. If you were to use the Bates-White's VAD calculation, this is the result you should have obtained instead of the own assumptions by Mr. Kazmarek. The third one is, and this is the third and fourth, you remember a snippet from the transcript of the resubmission hearing and the questions by Dr. Alexandrov as to whether or not these were washed out. There's the elasticity effects, and Dr. Abdallah says, well, the original tribunal does not address these elasticity effects. Since the historical period, the errors discussed are not present. They only appear in projections from 2010 onwards. I'm reading halfway through the paragraph there.